Hey everyone, my name is Jack. In this video, I want to go over some strategies for hedging a portfolio, but before that, I'll give some quick updates on the portfolio. For those of you new to this series, I'm building a $100,000 portfolio in M1 Finance using a variety of investment strategies within the portfolio, with some portions focusing on dividends, some on growth, and some on broader market diversification. If you guys want to use or adjust this portfolio for yourself, check out the link in the description below. It'll let you see all of the holdings and then adjust the allocations if you open up a free account with M1 Finance and copy it yourself. I'm not a financial advisor, but maybe it can be a good start to your investment journey or in addition to your existing portfolio, and you can adjust it to fit your specific risk profile. So not much has changed since last month. I added a little bit more cash, but have mostly held off since the last market rally. Not only do I think it's a bit overly optimistic right now, but the main reason I'm not adding more is because I'm currently shopping for a real estate deal still. Prices are starting to drop a little bit in Indianapolis, where I'm looking to buy my first out-of-state rental deal. Credit is also hard to come by right now, so I want to make sure I have plenty of free cash. Regardless, the market has been mostly sideways since April 15th, generally up about 2% or so, maybe a little bit less since my last update. It's been bouncing up and down steadily as people wait for news surrounding the pandemic and potential stimulus packages, and not to mention, with all of this uncertainty right now, many people are nervous about putting more money into the market or just about preserving their existing portfolios. So this brings up the question, how do you hedge a portfolio to protect against downside risk? So I'm going to go through a few effective ways to do that right now. A common way to hedge a stock portfolio is through bonds. Bonds are generally lower risk than stocks. And you might ask, why is this? Well, the main reason is what happens in default for a company. When a company fails and goes bankrupt, they have to pay their creditors first, the people who they owe money to. Stockholders are paid last. That's the extra risk you're taking with stocks. If the company fails, you are not paid. The people who hold the company's debt, like bonds, get paid first every time. Now, there's a chance that bondholders don't get paid either if the company really goes backwards and completely runs out of assets to sell to pay creditors, but generally that is pretty rare, and bondholders typically get something in default, and almost definitely more than stockholders, so that makes them lower risk. But lower risk means lower reward, so over the long run, we'd expect stocks to outperform bonds by a pretty substantial margin. So holding bonds is one way to mitigate the risk on a stock portfolio. I have some bonds in this portfolio and also some others, both in and outside of M1 Finance, but I've been taking money out of bonds recently to free up the cash to use elsewhere, both in stocks, but also in a potential real estate deal that I mentioned previously. Another way to hedge a portfolio is slightly more complex, and that's with options. Options give you the right, but not the obligation, to buy or sell a stock at a particular price. They are one of a few tools that let you make money when the market goes down. One way you can make money with options when the market goes down is to sell call options. This puts you at risk of having to fill an order for 100 shares if the stock climbs above that price, so selling options generally is used as a supplement to a portfolio. I don't want to get too heavily into option strategies in this video, but I'll leave it at that with options selling. The other way to make money with options when the market goes down is to buy put options. This is where you buy an option that allows you to buy the stock at a price in the future, and you only make money if the stock ends up below that option strike price by the time it expires. In other words, if I buy an option for a stock with a $100 strike price, and the stock gets down to $95, I can exercise that option to make a $500 profit immediately by buying 100 shares of the stock at $95, and then using the option contract right to sell them at $100. If you don't have the capital to buy 100 shares, you can also simply sell the contract like you would any stock, since the value is baked into that option. Ray Dalio and other hedge fund managers have had great success with this hedging strategy in recent months. I actually did videos on both Bill Ackman and Ray Dalio and discussed their recent plays to make money when the market was going down, which protected at least some, if not all, of their existing portfolios while the market plummeted in March 2020. Ackman especially was able to go on a buying spree with the cash he had from his puts, avoiding a lot of the devastation that many other investors faced at the same time. When you buy the put options, you can use them to protect your current holdings. That way, if the market goes down and your stock values go down too, your put option values will go up. The put options cancel out the losses when used this way. But what if the market goes up instead? Well, in that case, you will make money with your actual stock holdings as the put options value shrinks, so your stock gains would be canceled out as well. I'm using this strategy to some degree right now. Unfortunately, M1 Finance doesn't allow for options trading yet, so if we head over to my trusty Robinhood account, we can see that I have some put options to cover myself a bit if the market drops. These are spreads, which means that I bought and sold put options of different values at the same time, which gives you more defined risk and slightly less exposure per trade, but that's a story for another video. But this way, if the market goes down or even goes sideways within my spread values, I'll have something to protect a fraction of my portfolio. This is especially important for me because I want to preserve some of my capital so I have cash ready for my upcoming real estate deal or deals, and these put options are insurance policies in a way for some of my portfolio. If I wanted to be extra bearish, I could load up on more of these puts, but then I'm no longer hedging my existing portfolio and I'm really just making a full-on bet for a market dip. Yet another way to hedge a portfolio is through dollar cost averaging. That's where you have a lump sum of cash, and rather than investing it all at once, you only move in a fraction of it into the market periodically, maybe every week or month. What dollar cost averaging is at its core is just holding cash on the sidelines while slowly moving it into stocks. So you have a risk-free asset in cash that typically actually produces a slight negative return via inflation, while you simultaneously have a riskier asset in stocks. This helps to avoid massive short-term swings having a big effect on a portfolio generally, since a lot of it is tucked away in cash. But that goes both ways. You'll miss part of the big upswings in addition to the downswings. It's a fine strategy for those wanting to limit their risk when investing in the stock market, especially during volatile times. The last way to hedge a portfolio that I'm going to talk about here is by diversifying. And there are two ways to diversify. One is within the asset class itself, and another is between asset classes. One example of diversifying within an asset class is my Ben Felix-inspired slice of this portfolio. It's 3 broad ETFs, which are made up of hundreds, if not thousands, of stocks each. This is focused on the US market, and it could be diversified even further by bringing in international stocks. I have some international holdings in other portions of my portfolio, but my portfolio is definitely skewed to the US. I could add more international holdings to hedge risk through diversification geographically. Either way, with this, I'm not putting all of my eggs in one stock's basket. If one company fails, there are many others to make up for it. I actually have a detailed breakdown of this concept in the video linked above. The same goes for diversifying across asset classes. I do not have all of my assets tucked away in stocks. The majority of my assets value is in my home currently, with the next largest portion being my stock holdings. So I'm diversified across stocks and real estate at the moment. I am currently shopping for some rental properties to both diversify my real estate holdings and add another income stream. Having multiple assets and multiple streams of income is an effective way to hedge risk across your entire investment portfolio. If one asset class fails or is struggling, you ideally will have others to make up for it. You shouldn't become overly reliant on any one type of asset. Even cash has its own significant risks given the massive amounts of printing going on right now and the constant risk of it losing value to inflation. But if you guys want to open your own M1 Finance portfolio, check out my affiliate link in the description. They're a free brokerage with lots of great features that I've talked about on this channel time and again. I'll go ahead and link my review of the brokerage above, but whether or not you want to use M1, I also have some links to get free stocks on Webull and Robinhood, which are 2 more free brokerages. Basically, if you open accounts with them, they give you free stocks, so you might as well take a shot to see what stocks you end up getting. Those links will be down below as well. Well, that's all I've got for today. If you liked this video or found it helpful, like it, since it helps the channel out a lot. If you want to see more content on investing, the markets, real estate, and other personal finance topics, be sure to subscribe so you don't miss any of my new updates. I post new videos every single week and wouldn't want you guys to miss out. I also post an update to this specific series every month on the 15th as well. But definitely let me know if you guys want to see something in particular in the comments below. And definitely let me know what your investment strategies are, both currently in this volatile time and if it's any different from times that are less volatile. Are you using any of these hedging strategies? Why or why not? Let's get a discussion going in the comments below. But until next time, take care.